Hi, everyone. Welcome to TimingResearch.com Crowd Forecast News, episode number 233 for August 5th, 2019. Today we will be discussing report number 306, which you should be seeing in the video while I'm talking right now. You can also get your own copy of the report by going to TimingResearch.com/reports, and you can access either the web or PDF version of every report there. We're trying a new format this month where we're going to be recording the episodes, and then I'll be publishing them and releasing them within an hour of the recording being complete, and that'll allow me to generate sort of a more refined product. I can edit out any glitches or technical issues along the way and create a better product for everyone. So today I arranged for John Thomas, Jake Bernstein, and Simon Klein to join us. And John will be moderating. So I'm going to go ahead and turn it over to him.
Well, good morning, everyone. On this very eventful morning, as I'm checking the markets now, I see that the S&P or the Dow is down 750 points, and the bonds are up nearly 2.5 points. So it is the biggest moves of the year in a whole bunch of asset classes. Today we have with us a panel loaded with firepower, I should say. We have Jake Bernstein of TradeFutures.com, and we have Simon Klein of TradeSmartForex.com. Gentlemen, why don't you introduce yourself briefly, and Jake, let's start with you.
Okay, well, I am a rules-based trader, completely objective. I don't look at fundamentals, never consider the news whatsoever. Been trading for 52 years. I am a real trader. I trade what I teach, and I teach what I trade. I've written 45 books on trading, and I'll be let off my analysis here today.
Okay, well, great to have you on board. And Simon, talk about yourself for a minute.
Hi, John. I'm going to share my screen so you can see it a little bit. Oh, wow. Okay. So you can see everyone should be able to see the screen. I've been trading for probably around 15 years now. I started out straight out of university working for Credit Suisse in both London and New York. And that's where I gained experience working on the trading floor. Even though I wasn't working as a trader, I was supporting the traders and did portfolio and risk analysis. I started trading in 2005 after passing the Series 7. And my first trading account, I remember, I was given a $500,000 account. It's quite a decent amount of money for a beginning trader back then. And a number of years ago, I started off TradeSmart, and TradeSmartForex.com is the website. And the idea is to teach people how to read the market professionally. And that's reading the candlesticks without any indicators and teaching them how to run a successful trading business, the framework that you need to have in place and the process you need to go through step by step in order to become a successful trader. Okay, thank you.
Okay, great. Well, thank you all for joining us today. And I'm John Thomas, the Mad Hedge Fund Trader. Been in the business for 51 years now. I am the founder of MadHedgeFundTrader.com, and we trade stocks, bonds, commodities, precious metals, real estate, and energy, issuing long and short trade alerts whenever the opportunity presents. And of course, we started piling on the shorts last week, and we are just absolutely swimming in money this morning. So with all of that said, let's go on to question number 1. Which direction do you think the S&P index will move from the coming Monday's opening to the Friday close? That's August 5th to the 9th. And then I'll tell you the audience response, which I think is a little out of date. So Jake, let's go with you.
The market is behaving normally in terms of what it usually does this time of year. It will take a good deal of recovery for the market to close higher on the week. So at the best, the market can play catch up between now and the end of the week. But as I said, everything that's happening right now is normal in terms of the time of year. The magnitude of the move is a little abnormal. It's skewed. But the bottom line is everything's working according to the way it should. I don't expect we're going to close higher on the week, but there are some great buying opportunities developing over the next several days. So that's my little forecast.
Okay, so we have a down. How about you, Simon? How do you see things?
Well, if you look at the market the way it is now, it's difficult to say up that anything's possible. I think it's got a bit more downside to it. And on the down, we have to see whether that's going to get bought. I think it's likely to go down to that famous area, the 2,800 area looking on the E-minis. So I think down this week, even though we may bounce, but I don't think we're going to bounce. And as Jake said, I don't think we're going to go positive for the week.
Yeah, and this is John Thomas. I think a better question would have been, do you see the market rising or falling from now? Because we have fallen 750 points in the opening. And I'll answer that question, and I'll say I think we go lower from here. The natural target on this is the 200-day moving average, which is down 80 points in the S&P 500. It's only down about 220 points in the Dow. So we are getting close to a potential bounce area. But I think for the time being, people will just sell into every rally. They're way overweight the most leveraged sectors, the sectors that have gone up the most. So I think we have a period of pain, but eventually we do go back up again. The only question is 10% correction, or is this a December repeat where we were down 4,000 points? And having said all that, I can tell you that the survey response, 60% of the people were looking for a higher stock market by on the week. So again, it's wildly out of date given the change in circumstances. If this survey happened before the fateful Trump tweet on China, then it is wildly out of date. So question number 2, rate your confidence in your answer to question number 1 by estimating the probability that you are correct on the week's move. Jake, you want to give us your answer to that?
Sure. A couple of weeks ago when we did this show, I showed a chart indicating that the small trader sentiment that we've been doing every day since 1987 on the S&P was excessively bullish, and that was a precursor to a decline. In terms of the decline, we got our trigger, and we've achieved, as of today, all of our profit targets. So everything from this point forward is gravy. Frankly, I don't care what happens. I've achieved my targets, and so now it's all about trailing stops. Get stopped out, we get back in again. The market was overdue to take this laxative, and now that we've taken it, the question of where we're going to bounce from. The best way to determine that bounce is not, in my view, the 200-day moving average, but the 8-month moving average of lows, which is a different concept than most people use. But if you put up a chart, a monthly chart, 8 moving average of the low, that's where we're going, and we're getting close for a major buying opportunity. So this bull market is not over yet, but this way overdue laxative or purgative, whatever you want to call it, it's about time, and I'm glad to see it happening. In terms of my confidence, very high. It's always easy to be confident when you've achieved your targets.
I know. Simon, what's your confidence level on your answer?
On lower for the week, I'd say 50%, 55%, because it may bounce. We're coming down to some demand below, and the question is, where's it going to bounce? And always in a kind of downward moving market, when it hits demand zones or support zones, we generally have bounces up that generally go to make new lows afterwards. So moves up in downward moving markets are usually sold. I mean, yeah, that's generally what they are. And at the moment, we've kind of broken the trend we're in a downtrend now on the daily chart, even though we're still kind of potentially moving up on the weekly and on the monthly. So I think the level that we need to look for now is the 2,800 area. Maybe I'll just share my screen. Let's see if I can do that again. And you should be able to see that now. Is that right?
Pretty.
Am I showing this one or am I showing this one? I don't know which one I'm showing now.
I see a bunch of really nice green and red.
Oh, so you're seeing this one. You see my cursor move around, yeah?
Yeah, got it.
Okay, good. Excellent. So well, what's a trigger to get into this? And this is what Jake was talking about. So the trick for me would be if you look at the top here, once we broke the trend here, we broke the uptrend once we get below this level. And look how beautiful this was. We broke the trend on this day, on the last day of July. First day of August, we ran straight back up. This is a selling opportunity. We're already not in an uptrend anymore. So this move up on this day was selling, and then we've gone through this area, again, not the strongest area. So this is kind of nothing there. And if we're talking about where it's likely to go down to, well, again, if we look on the bigger time frames, you can see here, this kind of around this 2,800 area looks like the natural area. There's a zone over here, you can see on the monthly chart. And if it gets below here, then we're probably going to continue moving down. So again, this is still like a pullback on this time frame in a bullish market still. But we're no longer bullish on the daily chart. And generally what happens is you usually get downtrends, which are pullbacks on bigger time frame uptrends. So this is a downtrend now. We've broken below a number of significant pivots on the upside, significant pivot lows that pushed us to new highs. So, people may have their stops below there, which causes this kind of knock-on effect to the downside as well. But again, we're coming close to.
Okay. Then in that case, let's go on. I will answer this question. Rate your confidence in the answer to question one. Well, it's obviously 100% chance the market's down on the week. I would say 50% chance that it's lower than it is now. I think this is one of those markets where you really want to sell the first decent rally because for this sell-off to end, we have to create some sort of double bottom, and that means the next rally will be a fail. Also, one other complication for this market we're in now, we are one tweet away from a 1,000-point rally. After all, it was a presidential tweet that caused a near 2,000-point sell-off. That's just about where we are now. You could reverse all that by saying, oh, we just settled with China. The trade war is over. All is well and good. And then you squeeze all the shorts to death as you're currently squeezing the longs right now. So it is one of the most unpredictable markets in history. Nobody really has a trading edge because no one knows what the next tweet is going to look like. But that said, with this kind of volatility, making money is like falling off a log. So, we got all, the title of our Tuesday newsletter last week was The Idiot's Guide to Trading. And it showed all of the excesses that the market had reached to get to the point it was last week. So we had a whole batch of shorts just poised to go, and we actually started laying them out before the China trade war escalated, and we ended up getting the second half out right afterwards. So we actually did catch the absolute top on this one. Fundamentals, I know you guys don't look at fundamentals, but they are just deteriorating very rapidly. So that is another nail in the coffin of this bull market. So Jake, are you able to come back to us again?
Cannot. I'm working on it.
Okay, Simon, let's go on to question 3. What are the specific reasons you have for the S&P to be heading in the direction you chose, which is down?
Okay, I showed my charts. I can share them again. Let me do that.
Yeah, a chart is worth 1,000 words, maybe 2.
So the same thing, if we look at the trend, looking on the daily chart here, we look at the trend, the previous significant pivot to put us to new highs was here. We went below that at the end of July, on the 31st of July, as I said before. We break the uptrend. So moves up now are sellable. And we're still in sell mode until the market's able to turn around. The trend's down now and moving to areas, and I think potentially all moves to the upside now are likely going to get sold on this time frame. And we've just broken below this area as well. It's not the greatest demand area, but we've gone below it. So we've got that as supply above us, and we've got clear room, what you call like a tradable void now, to drop down to this 2,800 area and potentially here. Now, if we stop here and move up, then this may be where we start to move again and try and make to new highs. So how we would do that? We'd have to change the trend. So we'd have to move up, maybe pull back and fail to make a new low and put in a double bottom or something like that to change the trend, and then we'd be not in downward motion anymore. So the moment we're in downward motion, and it's natural for us to continue moving down until the trend changes, at least on the daily chart. Now, that could happen, as I said before. If we look on the weekly chart and the monthly chart, we're still moving to the upside. And this is the pullback in a potential upward moving market. So likely the upward moving market here will continue where the downtrend here ends. So we're going to be watching out for that. So likely we're going down to 2,800 area. If we turn to the upside, it will probably be sold until we get down here. And we'll watch for signs of reversal around this area.
Okay, well, very nice charts. I'll go ahead with my response. I use both charts and fundamentals. I've been working on fundamentals for over half a century, so I have a pretty good read on them. And going into July, we basically were cash all of July because we figured that the market could top out at any time, and that a great pivot point would either be the end of the month or the Fed interest rate decision on August 1st. So you had a whole bunch of dates piling up the middle of last week, which could have brought a reversal, and in the end, we got a huge one. But the basic problem is that U.S. company earnings are falling. In some industries, such as autos, real estate, and retailers, they are falling off a cliff. I mean, you're losing major sectors of the economy. Of course, agriculture is a disaster. You're looking at a replay of the Great Depression there, with ag prices hitting 10-year lows. And as of today, we have a complete ban on all agricultural imports by China, traditionally the largest buyer of America's agricultural output. So that's a disaster area there. And we went into this expensive, earnings multiple was 18 times. The historic range is 9 to 21. So going into these conditions with this amount of uncertainty at high valuations was an accident waiting to happen. So, and of course, August, best month of the year to go short. I mean, how hard is that? So we had our shorts lined up, we executed on them, and we're already taking profits just 2 days after the breakdown. So that's my response. And Jake, are you back with us again?
I'm going to give it a shot.
Okay, let's all root for Jake.
One moment, please. Trying to get back to my Zoom. One moment. Zoom won't cooperate, so I'll just say it verbally.
Yeah, give us the verbal.
I like to look at markets in terms of what's normal and what's not normal.
Mm-hmm.
Normal in the market teaches me nothing. You just keep on making money. I'm interested in the divergent opportunity. When do things become abnormal? That happened about 3 weeks ago. We had an abnormal situation. Price making new highs, but the indicators, in particular momentum, was not making a new high, confirming the move. Seasonally, excuse me, as John said, August is one of the best times of the year to be short. that is playing out right now. But that purge in the market leads to a turnaround and the usual seasonal bottom, which tends to happen over the next several weeks. So I'm looking at the market as an opportunity to be short, taking some short positions, taking some profits, and then reversing to the upside in sometime in the next 6 weeks. So that's the opportunity I'm waiting for. And I'm very happy to see this decline. It was long overdue. So without my chart, that's the best I can say right now.
So let me ask you this. What did you do in the market in July?
In July, we were taking off positions, and we're now short the market. I've been short for about 3 weeks now.
You were taking off long positions?
Correct.
Yeah, okay. All right. Well, thank you for that, gentlemen. And just for educational purposes, let me give you the audience responses to that question. Those who thought it would go higher said the market is still in an uptrend. All the chatter is positive. On a reversal, there'll be a lot of good buys, so it won't go down very much. There have been overreactions to the news, and they had their own pet technical analytical programs which said the market would go higher. Good luck with those. The lower respondent said trade war increasing in intensity and Trump fans the flames until China responds. Reverse from the top of the megaphone trend line will continue. Let's see. And those are the principal ones. Let's see. Let's see if I can find. There's a lot more reasons why it should go down. Economic uncertainty, low VIX, normal contraction in the March upward trend, pure momentum, wave 5 is finished. That's a good one. The downside correction started this week and will continue for one more week. August is the start of the crash season. That's a good observation. By the way, the crash season extends to the middle of October.
Correct.
The recent move was on expanded volume. Trade war with China will hurt consumer sector with no U.S. settlement in China in sight, protecting S&P down to 2,800. Well, here we are at 2,853, so that was a good call. Mood of the nation, which could be anything. Major top this week is a bad month. Major top last week. August is always a bad month for the market. There seems to be a new trend in place. The summer slowdown is starting. Just one word here, Trump. Daily RSI has crossed lower. Huge drop in momentum broken. Well, I have to tell you, all of the negative reasons are true. I'd have to agree with all of them. And if you had to put a real outlier there, I think the weekend massacres have affected people's moods and scared them and made them want to go 100% cash. So these are the audience responses, and I think we have a pretty insightful audience. There's a lot of good answers here. Okay, so let's go on to question 4, and you can spend a little bit more time on this. What procedures do you use for trade management, such as position size, stops, scaling in or out, etc.? Jake, you want to pick up the ball and run with it here?
We trade a diversified portfolio, stocks and futures. We make sure that we know our percentage commitment in terms of risk. Position size is determined based on risk per trade. Therefore, if the risk is too high, we take smaller positions. We use profit targets. First profit target is achieved, we reduce the risk effectively to 0. After that, everything is gravy. So it's really very simple. We never duplicate positions. So if we're in crude oil, we're not in heating oil. If we're in heating oil, we're not in crude oil. So we don't overweight. And we make decisions based on probabilities. And most of our work is based on seasonality. So when we have seasonal moves that have high percentage accuracy, And we take the seasonals back to the 1920s if we have data. So we're trading basically on the odds. And in terms of position size, always determined based on risk. So our formula is very simple. I'll turn it over to Simon.
Thanks, Joe. I do something very similar to that, position sizing depending on what the risk is on the trade on the chart and adjusting the position accordingly. So if there's a bigger risk on the chart, then we'll take a smaller position. If there's a smaller risk on the chart, we'll take a bigger position to try and keep the risk per trade kind of constant across trades. I will also tend to build into positions once, say a position is profitable. I may add it into the position and move my stop up to lock in profit and increase my position size to try and get as much out of the trade as possible. Again, depending on what the market's doing. So the market guides me into what I'm going to do. If I'm taking a scalp type trade, then it's kind of quickly in and out. If I'm taking a more of a position trade or taking a trade over a number of days and it pulls back and gives me another opportunity to get in again, so I'll get in again. I'm scaling in and scaling out on certain positions as well. So, and I always use stops. And yeah, there were times where I actually didn't use a physical stop. I had a money management stop. So if I reached that, I'd just close a position. And for those types of trades, you have to actually be in front of the screen because you've got no idea what's going to happen if you're not watching it. So again, if I'm kind of like market maker style trading, then I'm in front of then I'm most likely not going to be using a stop. It's going to be more of a money management stop. If I reach that, I just close the trade. So, but most of the time I'm not doing that. And I'm trading with regular stop and position sizing. That's basically how I manage trades and money management as well.
Let me add one thing. It took me about 15 years from when I started trading in 1967 to realize that the big money is made in the big move. So even though the temptation is always there to take a few $100 off the table, and it's satisfying and gratifying and fulfills a need, bottom line is that 80 to 90% of my money is made on 10 to 20% of my trades. So we are always holding for the big move, reducing our risk effectively to zero, not taking small amounts of money off the table, but in fact, reducing risk to zero when we hit our first target so that we can get the big moves. And of course, what's been happening over the last few days is qualified as the kind of big move that I like to get.
Okay, well, David, if you're listening, if you can put that page up on Zoom that I sent you. Mad Hedge Fund Trader basically covers everything all the time. We cover stocks, bonds, commodities, precious metals, energy, and real estate. And we are looking for long positions in the cheapest names and short positions in the most expensive ones. So over the last 10 years, we've averaged a return of 33.13%. We currently are up 21% on the year, so we're actually running ahead of schedule, and that's because we had a huge January, and also August is also looking to be a pretty hot month. And the great thing about this strategy is that you can basically run neutral portfolios all the time. You can be long stocks, you can be short bonds, you can be long stocks, short the British pound against it, or short oil. And this strategy is called long short global macro. It's been around for about 35 years. I was one of the earliest practitioners. This has also been the same strategy used by some of the investment greats like Julian Robinson and George Soros, Paul Tudor Jones, and David Tepper. All of those people used to be clients of mine when I was at Morgan Stanley. So as far as positions, we run a model portfolio of $100,000. Each individual position is $10,000. We very rarely are 100% invested. We're kind of like Warren Buffett. We always like to have a wad of cash in case something special happens like this week. So that is our strategy. Also, one other key element is that we stop out of losing positions very quickly. I had a short in the bond market last week, which I got out of post haste because it is much easier to dig yourself out of a small hole than a large hole. And watching customers react for the last 50 years, I can tell you the largest source of individual investor failure is failure to get out of losing positions quick enough. You can have 10 winners, all of those profits can be wiped out by one single bad trade that people hope to get up to cost, turn around, bounce, whatever angel they're praying will come rescue them never shows up. So
well spoken, John. Well spoken.
yeah, that is believe me, I learned all this the hard way when I started out. There weren't any books. In fact, there wasn't even any computers around when I started trading. There were 3x5 cards, and that was about it. Certainly the internet was 30 years off. So yeah, learn from my mistakes is my strategy. Okay, so has Simon, did you cover your trading disciplines and procedures on how you manage trade? Jake, I think it's your turn to have a shot.
I think I covered that, and so did Simon.
Okay, so let's see.
You guys want to do an individual trade idea of the week?
Yeah, that's a good idea. Jake, what's your trade idea of the week?
We've been long gold for about 6 weeks now as a hedge against what we start coming in the market. Strategy is to buy gold at support, which is about $20 lower. And the way things are going, it could happen in a heartbeat. What you said earlier, John, about the market being one tweet away from a 1,000-point rally is very sage. Totally agree with that. We need to be very quick and nimble because one tweet from Trump can change the whole complexion of things instantaneously. So if you're a short-term trader, it's a beautiful environment, but I think gold hasn't seen its peak yet. In fact, gold toward the end of this month begins its seasonal uptrend. And so if we've seen so much upside before the seasonal uptrend begins, we're destined to see much more on the upside once that seasonal trend begins. So we want to be long gold on declines to support. In addition to that, if you trade the grains, this is the kind of news that makes bottoms in grains. So we're looking for opportunities to buy soybeans, corn, and wheat, and we're factoring that we're already long corn.
All right. Simon, how about a trade from you?
I'm going to mention gold as well. I've been mentioning it also for quite a number of weeks now, actually for a number of months. I'm going to show you my chart. I mentioned it way back when on this show, when we were down here, and also probably when we were down here. But this is a classic kind of pullback that's buyable, and you can see the market turn around here, and it's not over yet. This is still got more upside, and I've been pointing out to the next area that we could see gold going to is around this 1600 area, and it could easily break that as well. But this is a natural next stopping point. We've gone above this whole sideways consolidation basing area, and it's moving up. So markets will continue moving in that direction until they don't. So this is a natural next stopping point around the 1600. And when you got in the trade around the 1300, you're already over halfway there. So
right.
Around a $300 move, and we're over 150, or actually about $175 up already. So this is the entry down here. And if you got in last year down here, then even better, buying pullbacks down to demand areas. But this is even better, and this is most likely to break above this high. Once you understand how to read bases, and the odds are pretty high. You can see we went straight through in this month, right the way through the top. That means we're going to continue moving higher. Now you've got to watch obviously the short-term timeframes as well, and you're going to use them to help get in. But notice how this day we tried to go down and we got bought again today. Yeah. And it's looking likely we're going to continue moving up, but we do have some short-term supply. We look at it on the weekly chart, what that is. We've got this drop from here. So it could possibly pull back from here, and again, a viable pullback for the time being, unless of course it breaks the trend. And if we go, once we get above here, we should have a clear run up to 1600. So that's what I'm looking at. Another interesting one to look at And we've been following that as well as Bitcoin futures. It's not really a day trade. It's not really day tradable, even though there are people that do day trade it. But we've been looking at all the interesting, like buy it down in this area on this pullback. You can see we're now coming up to supply. And again, this is potential, got a lot of upside potential. We could get back to previous highs. This is when the market started to get bullish again. And it was a beautiful buy opportunity on the weekly chart. Once you know how to read this, this puts in kind of the potential bottom. Once you get this pullback back down into the area and it turns up, that's the bottom, and off you go.
All right. Well, I think I'll chime in with everyone and go in on the gold trade also. We've been recommending gold all year. And let me throw in some fundamentals since you two guys are technical guys. Central bank buying of gold is at a 50-year high. In the first half of this year, the central banks bought 374 metric tons of gold, and that is more than they purchased all of last year. The big buyers are Russia, Iran, and Turkey, who are all buying gold to try and circumvent U.S. economic sanctions. And then the world's largest seller, which has been Venezuela for a couple of years, is almost completely out of gold. The Russians made off with a big chunk of it earlier in the year. So yeah, gold looks good. It's a hedge and also has the fundamentals as a basic commodity. And what does gold love the most? Competition from interest rates going to zero. And that's exactly what interest rates around the world are doing, are going to zero. In fact, if you look at gold against yen or gold against euros, it's actually risen a lot more. If I were to do one other trade this week, I'm starting to cover shorts. You know, we're down near 2,000 points or about 7%, literally in 4 trading days. So I covered half of my shorts this morning. We just ticked down 750 points on the day. So I think I'll cover one more short as soon as I get off of this webinar. You know, you want to book your winners. Don't let them grow hair. Otherwise, they may disappear overnight. Nothing than making a max profit on one position and then losing all the next day just because of some tweet. Okay. Anyone else have any general comments on the market?
The market is doing exactly what it should do at this time of the year. But I think people get spooked because of the magnitude of the moves. But they don't realize that when you're looking at all-time highs, the percentage is what's important, not the point magnitude. So people look and say, 70 points on the S&P, that scares the hell out of me. Well, the bottom line is, what's 70 points in this environment at new highs, new all-time highs or close to it? So the small trader doesn't like to look at things like that. They like to get scared by things that are really insignificant. Some of my best work has been monitoring what the small trader does and then doing the opposite, not immediately, but using the small trader sentiment as a setup, which is one of the best leading indicators we have, which is why 90% of our clients who buy the daily sentiment from us are hedge fund clients all over the world, as well as other newsletter writers and traders. So it's very important to monitor the small trader. And the survey that you've done, I'm not sure if it gets at the exact heart of what we're looking at. What we're looking at in terms of the small trader is, what do you feel in your gut right now? And that's what is important to me. So I want to look at what's a small trader doing right now? What are they feeling right now? I don't want their explanation. I just want to know what their gut tells them. And that's, for me, the significant difference in terms of assessing sentiment of small traders. You also have to be careful what small trader you're looking at. If you're looking at all traders, you're not necessarily isolating the kind of trader that you want to look as a contrary opinion indicator. So that's my 2 cents worth right now.
Okay. Jake, any words of wisdom here?
We're looking for places to buy. We've achieved all of our profit targets. It's been a wonderful opportunity. I like to see the panic developing because it has to clear the way and purge the market for another move to the upside. But that move may yet be 3 to 6 weeks off before it happens. But I am looking down the road at one heck of a big rally going into the end of the year. I think it's going to make a big difference for a lot of people. But But what's
Yeah, I
important to me
have to
is
tell you that after doing this for 50 years, panic is where you make all the money.
that's right.
Panic on the downside, panic on the upside. Uh, the middle, you're just nickel and diming it, just trying to stay awake. So I certainly go with the panic sort of things.
Just let me say one more thing about day trading.
Hmm.
Even though I wrote the 4 best-selling books on day trading from McGraw-Hill, I am not a day trader anymore. I think day trading is a losing game for most people.
I couldn't agree more. Most people can't do it.
They can't do it. They don't have the technology to do it. They can't beat the machines. They're too scared. Every time they see an opportunity, they make a quick decision. They go for the small move. And so all these ads you see, learn how to day trade, day trading methodology and all the rest of that stuff, it's pure crap. It's designed to get people into the market so that you can sell them something else that might be better than what you're teaching them to begin with. And since what most people teach to begin with is not objective anyway, they're off the hook. They hide behind that big CFTC disclaimer and say, past profit does not indicate future results and all the rest of that nonsense. So the big money for me is made in the minimum 3 to 5 days, but maximum 6 to 7 months or longer. And that's where I think most people should be focusing their attention. One of the reasons that we've seen this big decline is people have been lulled into a false sense of security. They're saying, well, we don't have to worry. Every time the market goes down, somebody says something to make it go back up again. We're impervious to all the crap that's going on all over the world. The seizing of the oil tankers, Iran, Iraq, Middle East, and all the rest of the stuff. See, the market just keeps on going up. It has a mind of its own. And when people get lulled into a false sense of security that way, it just comes back to bite them in the ass. And that's what's happening now. There's my very sage 2 cents worth.
Okay, Jake, anything to say here?
That was Jake.
Oh, sorry. You both sound similar. You both have the same accent. Simon, why don't you give us?
Really? I'm British. Jake, you from England?
No, I'm from Santa Cruz, California.
All
Yeah,
right.
you're not far away. I'm over in San Francisco.
Okay, not far away at all.
Okay, Simon, give us a nice overview here on what to do.
I think that accounts for your British accent.
Yes. Yes, I was born and raised in England, Manchester, London. I lived in New York for a while as well. When I was working for Credit Suisse, I lived in New York. Yeah. But I would say that if you have I have someone that I trained who's doing extremely well, trading momentum on the cash open of the E-minis and the NASDAQ, the NASDAQ futures and oil futures, actually. And she's basically in and out of trade, sometimes in the market, maybe 15 minutes a day, 15 minutes to an hour a day, and that's it. And she does very, very well, almost no losing trades. She plays a momentum breakout of supply and demand zones and plays it to the next level. So an example of that would be, if you look on the E-minis, this would be like an area. So she'd probably short this, which is around the cash open here.
Are you sharing your screen, Simon?
Oh yeah, let me share with you. And it's a day trading strategy that she developed based on a framework in which I teach all my traders. Yeah. So it's not just one strategy. You can build anything. Once you understand how to read supply and demand, price direction, and trend pivot analysis, you can see we're putting a downtrend here. But the cash open today here, if you look at this was the cash open over here. So she'd probably play it on the break of this area and take it down to the next level, which may be all the way down here. So the risk is small. Yeah, so you play on the break of this on the lows here, play it over here on the short side, put your stop above here and just let it go. And if she was in it for 15 minutes, then maybe she would have gone out over here on the first move down. And again, she's looking to make consistent profits every day. Even if she leaves something on the table, she's making consistent every day.
Simon, at my age, it takes me 15 minutes just to go to the bathroom.
Yeah, so I mean, she's found something that works for her. She does it every day. She plays a momentum off the market open. Again, there's a lot of movement then. If you pick the right direction and get in, then it goes and you get the first 15-minute bar, so to say, and be done, close down and get on with your life. So that's what you can do. And you got to have a strategy for doing that. So, there's one way of looking at it. It's easier to predict what's going to happen in the short term, in the next 15 minutes. We all know where we're likely to be more in a shorter period in the short time scale than we are in kind of long time. Like if we ask people where you're going to be in 10 years time, most people don't know, but they might tell you where they're going to be in 15 minutes time. It's easier. So that's why a lot of people may be attracted to day trading. Also, I would say about day trading, the good thing about it is you can go to sleep at night and you don't have any open positions. You've mostly closed your positions, so you're not carrying risk through the night. I know some of my traders can't sleep if they have positions on, and they may be kind of tempted to stay up all night watching them. So it depends on your personality. Again, day trading is not for everyone, and nor is position trading or long-term or even swing trade. You have to find something that fits your personality and your lifestyle, and find a strategy once you've got a framework of reading the market that fits you, and develop it. Primarily, develop it, test it, prove it works, and then trade it. That's what I would say.
So, Simon, may I give you a little pushback on that?
Sure.
I have personally trained close to 1,000 traders one-on-one. I find that most people come into the markets these days with the great anticipation of making money day trading for all of the reasons that you cited. You can sleep at night, you can get out during the day, but I have seen very few people these days, maybe 10 years ago, yes, but nowadays the probability of success is extremely low. So I would say I would rather make a small amount of money over a short-term trade with high probability than try to make a large amount of money during the day with low probability. In terms of the odds, I've seen and developed my own day trading methods. They've been good, but at my age, I'd rather do something constructive with my time and go for the big move with less effort. So you're right, in terms of personality, it depends on what fits you. But I think the probability of success competing with the machines is extremely low. And I can't in good conscience counsel most people to day trade, whether it's Forex, S&P, bonds, or otherwise. I just don't see it working for most people. But again, that's my experience, not to dispute your experience, Simon.
I'll tell you one other thing on the man versus machines dispute. Leon Cooperman said something interesting last week. He used to be a client of mine. He said, machines know everything about price and nothing but value. And in that world, technicals produce far less money than machines can, whereas fundamental research, which machines have no idea how it works, are at a disadvantage. So the only way to succeed in these markets is to concentrate on the fundamentals. But then that's just been my experience. You can't, if you and a machine compete on a one-to-one basis, the machine will lose every time. The only extent to which machines can get into fundamentals is on keywords. So if they see the words rate cut, they'll automatically respond. If they see the word Trump, they'll automatically respond to that. And they can do it far faster and more effectively. They'll be in and out of that trade before you even have a chance to turn your computer on. So,
may I say something, John, in response to that?
Yeah, go ahead.
That depends on the machine. The level of sophistication of machines with artificial intelligence these days is accelerating exponentially. I predict that within the next 5 years, there will be no individual that can beat a machine. I believe that technical analysis is all going to machines. Most trading will be artificial intelligence, which will combine the better parts of fundamental analysis with technical analysis. So I think if traders really want to get current and be prepared for the future, they need to learn how to deal with machines, how to develop their own machine learning strategies, because that's where it's all headed, in that direction. And it's going to be a significant change in what we're doing right now.
Well, I've been dealing with machines ever since they came on the scene about 30 years ago.
Likewise.
If you recall, it was computer-driven portfolio insurance that caused the 1987 crash, where we dropped 20% in one day. So we've heard a lot of promises about what machines can do. And when I say machine, I mean mainframes run by PhDs from MIT who are at the cutting edge of artificial intelligence. I'm not talking about, the desktop you bought from Hewlett Packard for $1,000 running Windows. The amount of money that goes into these algorithmic trading operations is in the tens of millions just to get started. So, and remember, they all go home 100% cash at the end of the day. There's one thing I have learned is there's now a big premium on running overnight risk that didn't used to be there, thanks to the machines going 100% cash by the end of the day. And there's even a bigger premium running positions over a weekend. And of course, the proof in that is the meltdown we got in the market this morning. We ran all our shorts over the weekend. A machine would never do that. And we got paid off big time this morning. So,
John, depends on the machine, sir.
yeah, well, believe it or not, there's still room for humans left. People have been promising to have machines put me out of business for 30 years, and I'm still waiting. Okay. David, do you have any more questions you want to throw in there? We have about 5 minutes left.
I think that's it. If you have anything else, go for it. Or if you guys just want to do a closing statement.
Yeah. Okay. Jake, you want to give us one more reminder of who you are and what you do and where to find you?
I've been trading for 52 years. You find me at jakebernstein.com. See what I do. That's all I have to say about myself. It's been real. Thanks, guys.
Okay, Simon.
Thanks, Jake. I'll share my screen quickly again. You can see it. You can go to my website. My name's Simon Klein. Been trading for not as long as you guys, but 15 years. And been in the industry for much longer. And you can find out everything you want from my website, tradesmartforex.com. If you want to email me, my email's over here, simon@tradesmartforex.com. And you can put your information in here, put your name and email address, and get a video and be on my mailing list of how to build a profitable trading strategy in 15 minutes. I'll take you through what you need to know. And you can go and follow me on social media. I'm not so big on social media. I do have a YouTube channel and a following and Facebook page, so feel free to do that. And currently there's a webinar I did for Traders Talk Live over here, which you may find interesting. You can click on here and see what it will teach you how to become a successful trader with any size account. That's a lot of what people ask is how much money do you need to learn how to trade? So this will address that. And most people go about it the wrong way. This will show you the way that you need to go about it and ultimately what account size you need. And again, it depends more on, well, I'll leave that for you.
Okay, and David, if you can put my page up again. This is John Thomas, the Mad Hedge Fund Trader. And as I speak, we are down 756 points. And that gives us plenty to do. We are long, short, global macro. We cover stocks, bonds, foreign exchange, precious metals, energy, commodities, and real estate. We are averaging 33.13% a year in performance. We're running a little hotter than that right now. And you can find us at www.madhedgefundtrader.com, where, by the way, you can sign up for a free research product. Just put in your email address and your name, and you should start getting stuff on a daily basis. So this is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading, and thank you, gentlemen, for joining us today.
Thank you, John, and thank you, David, for putting on these shows. You're doing a great service for people.
All right. Thanks, guys. And yeah, thanks, Jake. Glad you're enjoying it. And just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory. Also, you can access any of the past reports or show archives on TimingResearch.com. As I mentioned at the beginning of this episode, this is the first of my new format where I'm recording and then releasing an hour later. So if you have any questions or comments about this, just send me a message on the contact page on Timing Research. And be sure to join or watch for tomorrow's episode, Analyze Your Trade, episode number 88. Larry Gaines and Mike Pisani will be on that one. And I just want to thank my guests again for today. Jake Bernstein of trade-futures.com, Simon Klein of tradesmartforex.com, and John Thomas of madhedgefundtrader.com. Thanks, guys.
Thanks,
Thank you.
David.
Thank you.